You probably think the rich avoid taxes through illegal schemes, hidden bank accounts, or offshore conspiracies. But here's what actually happens. The wealthy don't break the law. They follow it so carefully that they've learned how to use it in ways most people never discover. And if you want to understand how money really works in this country, you need to see this clearly. So if you're curious about how the financial system actually operates, subscribe to this channel for breakdowns on wealth, finance, and the systems that shape our economy. Let's start with the biggest misconception. When people think about tax avoidance, they imagine criminal activity. They picture secret accounts in the Cayman Islands or briefcases of cash being moved across borders under cover of darkness. But that's tax evasion, and it's illegal. What the wealthy do is fundamentally different. They engage in tax avoidance, which is entirely legal. The difference is crucial, and it changes everything about how we should understand wealth accumulation. The real mechanism starts with understanding that the tax code isn't a simple flat rate applied equally to everyone. It's a labyrinth of rules, deductions, credits, and structural opportunities. Congress writes these rules, lobbyists influence them, accountants and lawyers study them obsessively, and the wealthy exploit them systematically. This isn't a secret. It's written into law. The government essentially permits certain financial behaviors because they serve policy goals. Consider charitable giving. When a wealthy person donates to a charity, they receive a deduction on their taxable income. This seems straightforward until you understand the mechanics at scale. A billionaire can donate appreciated assets, stocks, real estate, artwork that have grown significantly in value. They get a deduction based on the current market value of that asset. But here's the key. They never pay capital gains tax on the appreciation. That's hundreds of millions of dollars in potential taxes simply erased by the structure of the donation itself. Foundations operate as the next layer. A wealthy individual creates a charitable foundation and funds it with appreciated assets. They control the foundation. They decide which charities receive money and when. The foundation itself is tax exempt, so the assets grow tax-free indefinitely. The founder can even pay themselves a salary as the foundation's director. This isn't charity in the traditional sense. It's a tax-advantaged holding company that lets you control significant wealth while receiving deductions from money you haven't yet distributed. Then there's the concept of a stepped-up basis, which might be the most powerful tax tool available to the wealthy. When you hold an asset and it appreciates in value, you owe capital gains tax when you sell it. Your heirs inherit that asset at its current market value, not what you originally paid. That means all the appreciation during your lifetime is completely erased from a tax perspective. If you bought stock for $1 million and it's worth $10 million when you pass away, your heirs can sell it immediately and owe zero capital gains tax on that $9 million gain. Deferral is another crucial strategy. The wealthy don't necessarily avoid taxes. They defer them, sometimes indefinitely, through various investment structures and partnerships. Income can be pushed into future years or carried forward through the decades. When you're operating at that scale, deferring taxes for 20 or 30 years means investing that money tax-free in the interim. The returns compound over time. By the time you finally pay the tax, you've already earned substantial additional wealth from money that would have been taken by the government immediately. Real estate is a playground for this strategy. When you own investment property, you can depreciate it on your tax returns, deducting the theoretical loss of value each year. This creates paper losses that offset other income. But the building itself doesn't actually lose value. You're using a tax code provision to claim deductions for something that's potentially appreciating. Then, through a mechanism called a 1031 exchange, you can sell that property and immediately roll the proceeds into another property without paying capital gains tax. You can do this indefinitely, deferring tax year after year while your portfolio grows. Corporate structure is where wealth truly multiplies its tax advantages. When you're wealthy, you don't earn a salary the way most people do. You own corporations and entities. The corporation can deduct business expenses, pay you dividends, buy back stock, or retain earnings. You control the timing of when you recognize income. You can structure deals so that your personal tax liability is minimized while the asset value grows. This is why wealthy people often appear cash poor on paper. Most of their net worth is tied up in appreciating assets held through various entities. none of which generate taxable income on an annual basis. Loans against assets represent another layer. Instead of selling an appreciated asset and paying capital gains tax, you can borrow against it. Banks will lend you 90% of the value of your stock portfolio or real estate holdings. You now have cash to spend, but you haven't triggered any taxable event. The loan isn't income, so you owe no tax on it. When you die, your heirs inherit the assets and the loan debt, but they also get the stepped-up basis, so the asset value resets. They can then sell the asset and use the proceeds to pay off the loan with potentially minimal tax liability. Meanwhile, you've accessed the wealth without ever paying tax on it. Private equity and hedge funds operate through partnership structures that allow wealthy investors to pay significantly lower tax rates than salaried workers. Capital gains rates and carried interest mechanisms let fund managers and wealthy limited partners reduce their effective tax rates to single digits, sometimes lower than what middle-class workers pay. These structures are perfectly legal because Congress created them and has repeatedly chosen not to change them, despite decades of calls to do so. Tax loss harvesting is a strategy accessible to wealthy investors that's nearly invisible to the average person. When an investment declines in value, you can sell it and realize a loss. That loss can offset other capital gains or even some ordinary income. But here's the sophisticated part. With enough capital, you can continuously harvest losses while maintaining exposure to the same market through similar investments. You're reducing your tax liability without actually reducing your investment positioning. The wealthier you are, the more aggressively you can do this. Family limited partnerships allow wealthy families to transfer assets to the next generation at significant discounts. If you own a business worth $100 million, you might be able to transfer it to your children at a 25 or 30% discount for gift tax purposes. The discount exists because limited partners have less control than general partners, but your family still owns and controls the assets. You've just reduced the reported value for tax purposes by $30 million. Multiply this across multiple generations, and you understand how some families preserve vast wealth with minimal taxation. Trust structures add another dimension. A trust is a legal entity that can own assets independently of any individual. The wealthy use trusts to distribute assets, control who benefits from them, and determine tax liability. Grantor retained annuity trusts, intentionally defective grantor trusts, and dynasty trusts are names that sound complicated because they are. But what they do is straightforward. They shift asset appreciation to the next generation at a fixed value for tax purposes. A parent can transfer millions in future wealth while using little to no gift tax exclusion. Timing is an underrated element. The wealthy can recognize income in years when they anticipate lower income, or push income into years when they're in lower tax brackets. They can bunch charitable donations into certain years to exceed the standard deduction and itemize. They can exercise stock options in specific windows. They can close business deals in December or January, depending on their tax position. For someone with complex financial affairs and professional advisors, every transaction is timed strategically. Now here's something crucial. All of this is perfectly legal. These aren't loopholes that exist by accident. They're intentional features of the tax code. Congress wrote them. Congress could change them tomorrow if there was sufficient political will. Some provisions exist because they serve legitimate economic purposes. Depreciation deductions encourage building and real estate investment. Capital gains treatment encourages long-term investment. Charitable deductions encourage philanthropy, but the net effect is that those with sophisticated knowledge and significant capital can legally reduce their tax burden to a fraction of what it would be under a purely flat system. The average person cannot do these things. You need capital to borrow against. You need assets to appreciate. You need enough complexity to justify hiring expensive accountants and lawyers. Most importantly, you need to be aware that these strategies exist. If you're earning a salary, your taxes are withheld automatically. You don't get to time income, bunch deductions, or defer recognition. You can't create a family limited partnership with a few $1,000s. You can't borrow against a primary residence at the scale that generates meaningful arbitrage. This is why income inequality isn't just about earning differences. It's about tax structure differences. Two people earning $1 million might pay vastly different effective tax rates, depending on the source of that income and how it's structured. One might pay 40%, The other might pay 15%. The difference isn't criminal activity. So, when you hear that billionaires pay lower effective tax rates than teachers, you now understand the mechanism. It's not because they're breaking the law. It's because the law permits and even encourages certain strategies that are primarily accessible to those with substantial capital and professional advisory teams. The question then becomes political and philosophical. Should the tax code be reformed to close these mechanisms? Should everyone pay a flat percentage regardless of source? Should capital be taxed more like ordinary income? These are legitimate debates, and reasonable people disagree. But what we should all agree on is that understanding how the system actually works is essential before we can meaningfully discuss whether it should change. The wealthy understand this. They study it. They hire experts to navigate it. They make decisions based on tax implications. This knowledge gap is one of the most significant but least discussed factors in wealth accumulation. If you found this breakdown valuable and it clarified how the financial system actually operates, please hit like. It helps us reach people who genuinely want to understand money, rather than just complain about it. The uncomfortable truth is that the tax code is available to everyone. It's not secret. You can read it. The strategies I've described are legal and documented, but they require capital, knowledge, and planning. That's why the wealthy use them and most people don't. They've made understanding this system a priority. If you're thinking about your own financial future, consider this. How much of your financial planning accounts for tax structure? Are you earning income through a salary, which is the least tax-efficient way for substantial wealth building? Are you investing in ways that generate unnecessary tax drag? Are you aware of deductions and strategies you're not using simply because you didn't know they existed? These aren't immoral questions. They're practical ones. The goal here isn't to help you evade taxes. It's to help you understand that the wealthy aren't secretly breaking laws. They're using the same laws as everyone else, just with more sophistication. If you want to build substantial wealth, understanding these mechanisms isn't optional. It's foundational. And that knowledge starts with seeing the system clearly, exactly as it operates.